Okay, I think we are good to go, Jason. We are recording this call, this Self-Wealth Live. Welcome everybody to this pre-recorded version of Self-Wealth Live, the technical analysis edition, purely due to the fact that in Victoria, I know the rest of the country doesn't have a public holiday tomorrow, but in Victoria we have the Melbourne Cup. Jason, how are you today? You all right?
Hey, Rog, I'm good. I'm good. All good for a Monday morning to talk about these charts.
Yeah, Monday morning, and when you see this, when everyone sees this, it will be a Tuesday at midday. I'm not a big Melbourne Cup celebrator, but I will put on sometimes, small bit of money on the horse. What about you, Jace? I know
Yeah,
we've talked
used
about
to.
this in the past, actually, and I don't think you're a big horse race fan, but yeah, do you put something
Look,
on the Cups
I
or what?
love. I've always loved the races, and every year through the 1990s, I came down to Melbourne, went to the Derby, went to the Cup, had a terrific time, and yeah, I still keep an eye on things, but I've always loved a day out at the races. Haven't been a big bettor though, because the interesting thing is that my whole job has been around looking at markets and taking risk and managing risk. And so I date the races for the sake of having a few bets. That didn't interest me so much because I was doing that all through the week. So I'd go out there more for a bit of a social day out. And but it's so interesting watching people bet on the horses. Like after each race will finish, Melbourne Cup, people will be out there on the lawn at Flemington, and there'll be people cheering and jumping up and down and waving tickets, and it's different people each race which are getting excited, and then you see other people with their head in their hands. And I think for a lot of people, when they come to the stock market, they bring those same emotional principles along, where it's either toasting champagne or head in the hands, and it's a real situation where it's an emotional roller coaster. There's not a strategy, there's not a process, and it's very much all or nothing. And that's not what we want to do in the stock market. Although I think that those very same approaches people take to the races, they bring to the market, and that's what we like to talk about here, talking about process and not just treating your portfolio like a day at the track.
Well, I dare say that most people at the track are also a little bit drunk or tipsy or drunk, right? So I dare say if we treated that, if we all approached the stock market with the same amount of alcohol in our system, our systems will our plans and our systems will probably go out the window as well, right? With all the emotions. So yeah, it's a similar but different, right? So, but anyway, it's great to be here because today we're going to talk about, because it's pre-recorded, no questions obviously from the audience. So we are going to talk about the three markets and their status, especially leading into the US election today or tomorrow, which should be interesting. And then we're also going to talk about, I think is a great topic to know, not just as active investors or active traders. I think it's great for people. When I thought about this topic, I think so many people I hear talk about how much they've lost in the stock market, right? Well, if even you were to get a tip from someone and you knew how to work this on, as a system, as a way to get out and preserve your capital, then why not know it? Why not understand it? So even if you're a fundamentalist or someone that doesn't trade often, or a passive investor, so to speak, then why not know these principles of being able to get out using a stop loss or using a system where you check every day? Doesn't matter what kind of trader you are. Probably, when I talk about using stop losses, you can apply these stop loss systems in the self-wealth system itself. So you can kind of put it in, not forget it. You can set it. I wouldn't say forget it, but you can just make sure, have it there as a way to protect your capital if things were to go south on you. And these are tools that everyone should know, I think, if you're going to invest in the stock market. So I thought, why not have these three systems that we talk about? We've talked about them in the past shows as well, but I think this today being a pre-course, it'd be great to recap, and hopefully people are watching this outside of our audience as well, and maybe they can go into 2025 with new ways of thinking and being able to preserve capital as well, which is so important in this game. gain. All right. So, but before we get into that, let's have a look at our disclaimer. Thanks, Jace.
Yeah, so just quickly, we'll let me just grab this, and yeah, so this is just goes through general commentary only. Everything we do today, general commentary only, doesn't take your personal situation into account. And the other important point is I'm not part of Selfwealth. My business is motion trader. You'll see my details at the top, licensing, etc. And then beneath that, we have the Selfwealth disclaimer with licensing and all of that, and of course the general commentary only.
Fantastic. Thanks, Jason, for that. All right. So as the general viewers that always watching us know, we will go through our 3 markets to start off with, the 3 markets that we do offer at Selfwealth, and that is the Australian market to start off with. Obviously, our biggest product that we offer is the Australian market.
Yep. So let's jump over to our charts, and we've got the ASX 200 up here on the screen, and the pullback in the ASX 200 has gathered a bit of momentum towards the end of last week. Prices fell below the 50-day moving average, and then found support at around the 100-day moving average. And then from Friday's low, we've had a bounce. Much of this was in the futures market on Friday night as the US market was trading. There was the rally and opened on Friday up near the probably the midpoint of Friday's range. So is this the question I guess to ask is this a significant turning point, and should people get concerned? I'll come back to this, talk a bit more about that in a moment. Just recapping where we were last week, what we were speaking about last week. And we did talk about this quick reversal from the October high, and spoke about, like, here's the low point for October, had a nice rally, and then quickly gave all that back about 3 weeks ago. So we looked at that, and the thing with quick reversal where it retraces much of an earlier gain, it's often a sign there's more consolidation to come. So that was the point from last week, and the fact that October's rally was reversed so quickly, it just typically shows there's probably more time required. And that's what we're seeing now. We're seeing that more time and that more consolidation playing out. Now, one scenario which I did talk about last week, I said, look, maybe we could see the market, track sideways for several weeks, just above the moving averages, above this support at around 8,100. That hasn't happened. Instead, it's been a sharper pullback that's taken the market below the 50-day moving average, and we've got that zigzag appearance to it. You've got that classic zigzag looking shape to the pullback. So it now seems to be a case of that nervousness coming in ahead of the US election, people reducing risk, and maybe this is why we're seeing a larger sell-off or a deeper consolidation. Of course, I think the election, it's still the big focus point for the week. It's probably going to be a source of further volatility. But as it stands, ASX 200, it still has these rising moving averages. So you can see the 50-day moving average is rising, the 100-day moving average is rising. That's been pretty much the case over the entire year. We've had these moving averages in an upward position. The price has dipped below the 50-day moving average, but that doesn't signal a trend change. So some people will think, oh, look, we're below the 50-day moving average. Is that a change in trend? It's actually not, because even in a bull market, prices will pull back either to or even below a moving average like 50 days. I'll show you an example from an earlier bullish period. Let me just compress this chart a little bit. I'm going to go back to 2016, 2019. And this have a look at this 3-year. This is a 3-year period, 3-year bullish period in the market, and we've generally got these rising moving averages through most, not all, but most of those 3 years. But look at the price action. You got these several periods where the price comes down below both the 50 and the 100-day moving averages. Consolidation which went below the moving averages. So the moving averages give us a guide to where the overall trend is, but they don't work as like magic lines which the price can't dip below. we will see dips below the moving averages even within an upward trend. What bothers me is when the moving averages start to roll over and then the price goes beneath the moving averages and then consolidating beneath the moving averages. I'll show you what I mean. There's a good period. Oh, well, look, we had a period during 22 where moving averages started to turn lower, price consolidated below the averages, did have another rally, but then came down again, more consolidation below the averages, and then the weakness came in. Another good example from 2015, I was looking at a period where here, it's this period through here, where we'd had a strong upward period. Then the moving averages, well, price fell below the averages started to turn lower, and then we get the consolidation beneath declining averages. That's when the vulnerability comes in, and that's when I get concerned. At the moment, let's jump back to present day. At the moment, we don't have anything like that just now. We've got to pull back 2 averages, but the averages are still rising. So it's a very different structure to when the market starts becoming what I think its most vulnerable is. I think it's always a case that we should give the incumbent trend the benefit of the doubt, because most of the time the pullbacks come back to moving averages, they stabilize and they turn higher. Of course, at some point there will be a peak and there'll be a larger decline, but the incumbent trend, it's where the path of least resistance lies. I think if we expect the worst every time the market drops, and there's been plenty of drops this year, every time the market drops, if we expect the worst, it would constantly be selling, constantly going to cash, and that makes it hard to stay on these trends. That's why we've got to, I think, be able to accept the market's going to zig and zag its way upwards. For me, it's a case, Roger, of using those wide trailing stops, as it has been all year. Try to see off the pullbacks, which are invariably going to happen along the way. And I think the odds favour that what we're seeing now is another one of those pullbacks. And yes, it could turn into something bigger, but if it does, I've got that exit plan. I've got those trailing stops in place.
Yeah, I think it's obviously a great way to look at it because we don't know what's going to happen, right? But I think if you look at it from a technical point of view as well, you might have a few people going up there, and I'd be certainly looking at them going, "Oh, is this a head and shoulders pattern starting to form right up the top there?" But as you've said many times, at the end of the day, it's nice to be aware of it, but is that the deciding factor that you feel like it's going to turn? Because I can see many head and shoulder patterns in the past there that haven't eventuated to being a negative move in the end. Too much of a negative move.
We can draw a little head and shoulders in there, but you've got to put it in the context of a larger trend. This is a relatively small and short-term pattern which is formed over a few weeks. It takes more than I think a few week pattern to reverse a large trend. So that's a sign of consolidation, but that doesn't mean it's going to be a big trend reversal. I think the odds favour you go with the incumbent trend and put more weight in that rising trend over a year, and the moving averages still being in an upward phase, and playing it that way. Because look, as you say, you can find structure patterns that look like a head and shoulders reversal. You can find them in other places and they fail. And so it's something to be aware of. And we did speak about that last week. We spoke about the likelihood of more consolidation. So this doesn't really come as a surprise. It's like, but how do you manage it? Do you say, okay, I can see there's a small head and shoulders there and prices are coming back, so this must be the reversal. If you did that every time the market pulled back, as I say, you'd be jumping out a lot, and you find it hard to ride trends if you're always looking for turning points. Best, I think, to use those longer moving averages, use them as like the rudder for your portfolio, and try and help them enable you to stay the course when the trend remains intact, and accept that you will miss the peak, when it eventually turns, but hopefully you've stayed in a long trend for a considerable time and benefited largely from that.
All right, very good. Let's have a look at the US markets then. Similar thing happening over there.
So S&P 500. So it seems like the ongoing uncertainty around the US elections has finally caught up with the S&P 500 and the other US indices, for that matter, like the Dow and the Nasdaq. We're talking about last week about the scope for more consolidation, maybe a retest of the 50-day moving average, but I didn't expect it was going to happen in one day. And that's kind of what we got on Thursday. It quickly in one day came back to the moving averages. I was expecting something. Well, I was thinking more of a possibility like some sideways consolidation, maybe while the moving averages came up. But this is the thing: the market will do what the market will do. Dow and the Nasdaq had similar moves. I don't think this changes the underlying trend, just like we were talking about with the ASX 200. But I do think we should be ready for more volatility, especially over the next couple of days. By the time people watch this, it's going to be right, and it's right on election day. So for me, at the moment, just over the next few days, I'm probably holding off on buying. New buying activity. I'm also exiting stocks that have hitting their stop losses. I don't want to be holding losing positions at the moment that I need to sell, hoping they'll bounce back. Just especially with the prospect of volatility over the next few days, maybe over the next week. I think holding stocks, hoping they'll bounce back in this sort of environment, I don't think is the play. The potential for volatility, it's certainly there. So I'm just being proactive and shutting down unnecessary risk. I'm holding my best stocks. I'm not getting shaken out of those by a couple of down days, but I don't need to hold stocks which are giving me signs that they need to be sold. But really, let's just step back and keep it all in perspective, though, because the S&P, it's only 3% below an all-time high. And at this stage, the pullback, it's only come back to a 50-day moving average. And we often see this type of price action in bullish trends. And you just look at the price action from, just go back, just have a look at the price action from, say we look at 2020. Like, look at all these pullbacks back to the 50 and or in some cases back to the 100-day moving averages. They look unpleasant. They look like something larger could be happening, but they find support and they move higher again. And that's the nature of trends. They pull back, they consolidate, and they move higher. And I think that's the way to be approaching the current period. I'll show you another interesting thing. Let me go back to another period again, because I do like going back to other periods just because the structures they're always different, but they're similar in many respects. So here's an interesting period, and I showed this to my strategy session members on Friday. I think it's a really, really good one to take on board. So this was a period from 2016 through 2017, and we've got this period. These are all-time highs. So the market's making all-time highs for a couple of years. Then we get this period just in here in August. So market makes an all-time high, and then within a few weeks, it's quickly pulled back to the 100-day moving average. Not dissimilar to what we're seeing now. Now, what do you think people were thinking during this phase of the market? I'm sure if you went back and looked at some headlines or some news feeds of the day, there would have been some jitters about something in the market, people worrying about whatever it is to worry about at the day, and thinking, is this a change in trend? Here's your head and shoulders, Rog. There's shoulder, head, there's the shoulder, it's broken down. Is this a turning point? And as history will tell us, well, it wasn't. The market found support and it continued to rally. So the point is, we just can't look at every pullback as saying this is the turning point, because often it's not. It's not to say the current price action can't be a turning point, but I think the odds favour that it's not. Coming back to where we are now, it's not a dissimilar setup. Rising moving averages, prices coming back, definitely the potential for more volatility, and there's always the risk that a pullback can turn into something bigger. But at this point, we just don't have the evidence to suggest that this one is becoming something bigger. I think the odds continue to favour the prevailing trend. That's been the case all year. And we've had some scary pullbacks, but as we've spoken about, the August pullback at the time, it was keep cool, and the underlying trend is still up until we get markets below the moving averages. The moving averages roll over, and price starts consolidating beneath the moving averages. That's yet to happen. So at this stage, it's I think it's the prevailing trend is what to focus on. Doesn't mean be blind to risk. Know where your exit points are. And also, I just don't think there's a hurry to take on new positions just in the next few days. We can just step back sometimes, see how things play out. But it's certainly not a case for me, at least, of rushing to sell my best positions, which are up. Some I've got stocks which are up 100, 200, 300% or more. So I'm not rushing to exit those in this environment.
Yeah, I guess the key thing that you've told me there is the consolidation under an EMA versus all the activity above the EMAs at the moment, right? So for me to switch my mind around how these markets are looking is that whole point about seeing the price action consolidating under the moving averages, right? So I think that's such a key point to take out of what you've just said then, Jason. And you can see all the activities once again is above the EMAs there, apart from a few little blips that have gone under, right? So it's a good point, right? So good point.
Consolidating below declining moving averages is a point of vulnerability. It doesn't mean it's always going to turn lower. Like you can look at this example, just here. We had market was consolidating below moving averages. And if this is all, if we were looking at this in real, say this was now, I'd be looking at this and I'd say, look, this is the market's vulnerable. It's fallen below the moving averages. The moving averages are turning lower. There's a point of vulnerability. It's not saying that the market has to fall. It's saying that it's vulnerable and we want to take extra precaution to protect capital. In this case, it didn't break down, got back above the averages, and then the story changes to, okay, now we're back above averages. We start looking at this more from a long position. Is this a large basing structure? And that's what it turned out to be as we go forward. But if you look for markets that are consolidating below moving averages, that's when you start taking extra caution. You start being really being diligent with your exits, looking for the stocks which are breaking down, getting out of them, raising more cash, and waiting for conditions where we do have markets travelling above rising moving averages. That's when we make the money. When it's below the moving averages, that's when we take caution and protect capital.
All right, fantastic. Let's have a look at our final market for today, which is Hong Kong, please.
Not much change from last week. It's look at this. It's really just tracked sideways in a narrow range. Prices have stabilised after a period of quite a bit of volatility, really strong rally, then a sharp pullback, but now stabilising. I think this is encouraging price action that we're seeing. I like that the market's holding on to most of that September rally. So that suggests there's buying interest at these where the market's currently stabilising. That's where the buying interest is coming in and just underpinning the market. I think the stability also has the potential to build a new base or build a new platform at a higher level, and then this could become the platform for higher levels sometime in maybe in the weeks or months ahead. Moving averages continue to move higher. Maybe it's a case that this takes some more time. Prices track sideways and meet up with the moving averages. That's one way this could go. At this stage, I think the there are signs that this could be part of a larger trend change. It's been such a miserable period for the Hang Seng in recent years. Is this a basing period? And now is it starting to turn higher? So that's the way I'm looking at it now. I'm looking now, prices are above moving average, which are rising. I'm looking at this from an opportunity side. If they can continue to stabilize with these moving averages, then we start looking for a breakout. We get a breakout, that's when the opportunities start to kick in. So I think that's the way to approach this at the moment. And it's much the same when we go to the Chinese market, in that prices are stabilising above the moving averages. Looks like got that buying interest starting to underpin prices. And like Hong Kong, I think it probably needs a bit more time, but I think we should be looking at this as a potential trend change, and considering both China and Hong Kong as investment opportunities. Let's see how this continues to develop, but that's, as I say, that's what I'm doing. I'm looking at these as potential opportunities now, that it does appear that there's a trend change of note underway.
All right. Well, it's taken all year for us to see this trend change, but at least if you've been following us all year, you can see us talking about how it's changed now, and we're now looking at it as a potential opportunity in the future, which is great. So, all right. It's good. Good that we've gone over those three markets for today. The next topic on our list of things to talk about, obviously, is the topic of the show, and that is around stop losses. Now, I think for the way I feel sometimes when I hear people talking, obviously around trading and investing, I think a lot of people might think that stop losses are purely for maybe day traders. I don't know, people that go in and out of the market a lot more, but I don't think that has to be the case. And I think it's important to note that there is this function in a trading system, and there is these ways of having an exit plan, even if you're more of a passive investor or more of a passive trader. I think last week we mentioned you might want to you could potentially use stop loss strategies for more around companies, like single companies versus ETFs. Of course, you can still use them around ETFs, but ETFs are generally used more for longer term investing and and income, I guess. So maybe trying to exit out of it, an ETF might not be your strategy. Of course, that you've got to revisit your plan and your strategy. But I still think it's such a great thing to understand and know about, regardless of what kind of trader or investor you are, right? Knowing that there's that option there to preserve capital. Now, there's two ways of preserving this capital. Obviously, stop losses can work if you're in the red, in the negative, obviously, cutting your positions out, and you might not be on the computer. But also a stop loss works if you are well in the black or the green, however you want to look at it, right? If you're well in profit, right? And all of a sudden that stock or share or ETF, whatever, will start coming down on you, and you now have a plan to preserve the profit that you've actually lock in the profit that you've actually gained on that share, right? So stop losses don't only work when you're in red, they'll also work when you're in the green, obviously, as well, right? To preserve that capital. It's all about preserving capital if you want to stay in the game. So that, on that note, Jason, I know since I've started trading using your system, I've been a big user of getting out of positions quicker. All right, if they're not going my way. And also using the stop loss function as well on the Selfwealth system. I do a mix of using the stop loss. The way I use a stop loss function on the system is if I know it's heading towards my exit plan, I might put a stop loss on. If I wake up one day and I know it's gone over and the stop loss, I haven't set it, I'll just exit the trade, right? But ever since I've been with you, Jason, I've used this to great effect, and I think it's put my portfolio in a much better position ultimately, right? Rather than if I look at my other portfolio, which was my hit and hope portfolio, it's in a horrible position. I never used stop loss. I never even, and in hindsight, I probably should have, right? So it's all about learning, and that's what we're here to talk about today. And we're going to go over as best as we can with the time frame that we have, right? I think 3 quick systems we can use for clients, or for people, sorry, that want it. 3 quick systems we can use to be able to manage and preserve our capital, right? And that is, you can use a stop loss on the Selfwealth platform as well, Jace. So what do you think? What do you think we start with? Maybe showing them. I don't know which way. Do you think showing a percentage base to start off with, Jace? What do you think, Jace?
Yeah. Okay. Well, look, I think look, just generally speaking on the topic to start with, when we buy a stock because we think the price is going to rise. Naturally, that's why we do it. But we also should ask ourselves, look, that's all good. We're buying because we think the price is going to go up. But what if we're wrong? What if we're wrong? What if the price doesn't go up? What if the price starts to fall? Like, what do we do? Do you just say, well, oh well, it's falling, but I thought it was going to go up, so I just keep holding it? Or do you do something about it? Now, there are going to be people who buy stocks and hold them for 20 years. There'll be people who bought CBA in the float and have held it the whole way through, and that's fine if that's what you do. But I think the risk with just with a few exceptions, there are most stocks just don't really just keep going onwards and upwards forevermore. So that's where a more active approach to exits can be helpful. This is what a stop loss / trailing stop process is all about. So I describe myself as an active investor. So I'm holding stocks which I think could do well for maybe 1 to 3 years. So I'm not a day trader. I'm not a short-term trader. It's not about buy today, sell tomorrow. It's about trying to stay on these big trends, but then accepting that at some point that trend is going to go through a meaningful correction, and I don't need to sit through that. So that's where my stop can help me on my good trades, and the trades that just don't work out, I can get out of them fairly quickly, put the capital into another idea. So let's get an example. Let's get an example up and talk around that. So this is a stock. I've got this stock in my own portfolio. It's a telecommunications company, 2S Limited. TUA is the code. It's the 8th best ASX 200 stock over the last 12 months. So it's a good one to use as an example, because to show the benefit of a stop loss system, it helps to have a stock which has been in a trend. We can look at stocks which aren't in trends later on, but this has been a great trend. We've got these moving averages, see the rising moving averages. We spoke about that with the ASX and the S&P, how favour the trend. You can see it's got all the pullbacks to the averages, but the trend continues. Now I've got some markings down here on the chart. So this was a stock. We went from had a big corrective period over. That's a 12-month period where the price was pulling back. Didn't really want to be involved. Price then went from below the averages to above. The averages crossed, and it's got that typical structure that I like to look for, where it goes from below the average to above, consolidates along towards the averages, formed a nice little trading range, then broke higher. This was actually a motion trader signal in May 23. Another consolidation back to the averages, and this is where I bought in around May, early June 23. And so we get a trend forms. So how do you manage that trend? Like, how do we manage this and stay on this and not get it's like, that's a decent pullback there soon after I got in. And for a lot of people, that would be enough to say, oh, look, it's time to get out. But look, some of these trends can go a long way. How do you see off these pullbacks and know which pullback is deep enough to get out? Well, it helps, I think, to have a calculated way of doing it so you can keep it consistent and you know what to do. Now, there's a couple of, first of all, want to differentiate between a stop loss and a trailing stop. So a stop loss is what we might use early on in a trade. So you might get in, say you've used this initial entry, you might get into a stock and say, okay, I'm going to give it 20%. Or 10%, whatever it is, what you want to give it at the start. Yeah, I'll put a 15% stop on. I'll put my initial stop below the 100-day moving average, and if it starts to work, I can start increasing my stop. But that's my initial line in the sand. So what we want to look at today, we want to look at trailing stop. So this is where the market starts to rise and you start increasing your stop. How do you calculate how to do that? Now, three ways this can be done. You could use a moving average. You could use a moving average as your stop loss, like say a 100-day moving average. So if the price comes back to the 100-day moving average, you get out. You could use a percentage-based trailing stop. So you could say if a stock comes back by 25% or 20% or 10%, whatever it may be, that's your stop loss. Or you could use an ATR, or an average true range stop, which is using a multiple of a stock's average trading range as your trailing stop. So let's go, Rog, we can go through each of those. So let's start with the I'll put a percentage base. Let's put a percentage based on. So I've got one here that we will calculate for us. I'll put this on.
I've left the most complicated one for the end, which is the ATR one. So we'll stick with the easier ones. If people once again want to use an easier one, they can. And if they want, they can wait for the end to get the harder one, right? So
and this will help see the differences as well, because we can overlay all the stops on a few examples. So this is a 25% trailing stop. I like a 25% trailing stop. I think the advantage with this is and firstly, we'll go through the way it works first. So here's my entry point. It doesn't matter which one we use. Market rallies, and what it does, it uses the trade's high point, and then it calculates 25%. Calculates 25% of the stock's value, and then projects that lower. So it's an easy one to calculate. So if your stock's worth $100, or if your stock's worth $10, 25% of that is $2.50. Take that away from 10, and you've got a $7.50 stop loss. So easy to calculate. So every time the stock makes a high, the trailing stop will rise. You can see this period here where the stock is below its previous high. The trailing stop just sits locked at 25% below the previous high. Stock makes a new high, the trailing stop moves up with it. And this progresses the entire way up the trade. So the stop is always 25% below the high. So it's giving it plenty of room to move around. And you can see it's got these pullbacks along the way. So if you've got a tight trailing stop, you're not going to see off the pullback. So it's got to be wide enough to see off the pullbacks. You never know how deep a pullback's going to be. So sometimes it might hit a 25% stop loss, fall another 2% and rally. So you never know precisely. So you've got to decide on a level, and then I think be consistent. I think 25% works well for medium term approaches to riding trends. Just show you what I mean by setting it too close. So some people say, look, 25 is too wide. I only want to risk 10% on my stop loss. Problem with when you go 10%, look at this, you're getting knocked out all the time. So from my entry point, 10% stop triggers. Then maybe you get another entry point, and then it triggers again, and then maybe you get another entry point and it triggers again, and you're always getting stopped out. And so you could have, sometimes it keeps you in for a bit longer, but you're getting bucked off a whole lot of time. So rather than have multiple trades making not so much money, I prefer to set it wide enough to see off a good number of pullbacks. And it's also less work. It's less active. You're getting in and out less times. It's I'm still actively manage the portfolio with a wider trailing stop like 25%, but I'm having to do a whole lot less work. I've bought this stock once and I haven't had to do anything else. If I've got a tight stop, I've got to buy it maybe several times and exit it several times, and I'm probably going to make less money than if I just stayed on it the whole way. So that's why I like those wider stops. So that's one way we can do it. Moving averages.
I like that. What we'll do as well is, because I like the way you've got that set. So if viewers want those settings on, we're using obviously TradingView as a software. TradingView is separate to Selfwealth's platform or Motion Traders platform. It's a third party, but we might record those settings because viewers might want them, and we can put them in the comments or something moving forward after the video goes live, right? So all right, let's get on to the moving averages, please, because moving averages is something you can actually get on the Selfwealth platform as well, right? So yep.
Yeah, so that's a 25%. 25 is not magic. You could use 20% or 30%, or if you want to try and do short term, you can use 10%. But really, I'd think long and hard before deciding you want to be a short term trader, because it's hard. But that's for everyone to decide what they want to do. Moving averages. So the advantage of the 25% stop is that it's simple to apply, and I think it's effective. Now, some people will use a moving average as a ready calculated stop, and something which appears on probably most charts. You can probably get a moving average. So some people might use like a 20-day stop, a 20-day moving average, or I've got a 50-day and a 100-day. But you can see how often the market pulls back to a 50-day moving average. So if you're using a 50-day average as your stop, it's a pretty short-term sort of strategy. You can
that's the red line. That's the red line.
That's the red line. You can get some decent moves. You can look at this one here. That's a nice move, which comes back, and maybe that's triggered the 50-day stop there, or maybe it's this one a little bit further up. So you can get some nice moves there, but a lot of the time, you're not getting that far. So 50-day moving average is going to be a shorter term strategy. Even the 100-day, it triggers less, but it's probably going to be more prone to triggering than, say, a 25% trailing stop, which just travels a little bit further away from the share price, and it's going to be less likely to trigger. I think a disadvantage with using moving averages is that they're less effective at keeping you in during a consolidation. So you can see this consolidation through this recent period. When the share price starts traveling sideways for several weeks or maybe several months, the moving averages, just by the nature of their calculation, they will come up close, and the stock can be oscillating either side of the moving averages and still be within an upward trend, but that will trigger the exit. The moving average, which I think closest aligns to a 25% trailing stop, is 200 days. So let's just have a look what a 200-day moving average would look like. You can see the 200-day, it does fairly well hold in around that 25% mark. But unlike the moving average, unlike the 25% or the percentage-based trailing stop, which will have periods where it goes sideways. So here's a period, there's a high, we've got a sideways period of consolidation. The percentage-based stop will then just lock into a position and just stay at a fixed distance, give the stock time to move around. The moving average keeps moving higher because it's an average, and that's what it's going to do. It's going to keep moving up. So it's going to be less effective at keeping you in during a lengthy consolidation. But yeah, for those who don't want to do any calculations, just throw in a moving average. They're good possibilities to consider, especially I think the 200 for medium-term trend following. Now, one more, Rog. One more,
and ATR. I just before you go on that, I do like the fact that you've compared, they've put them on all together. Obviously, we might remove them when putting ATR on others becomes too distracting, but just being able to see the differences on how moving averages work versus a percentage base, which is based off the most recent high, right? I think it's just a fantastic way for clients. Once again, I really wanted this to be for people that weren't, more for passive investors to be able to see some of this stuff, right? So, because it's just great because we've got it all calculated for us. We don't have to do much work. It's just being able to see it in action is fantastic. Let's move on to the ATR, please. Stop. James?
So I'll take this one off for the time being. I'll put it back on later on. We can have a comparison. Now, this is what I use myself, or I use a variation of this. I use an ATR stop with just some tweaks which I think makes it a little bit more effective. But this will essentially do what we need it to do, this demonstration. So this is an ATR stop. So so what this does, this dynamically adjusts to each stock and each stock situation. What it does, it calculates, so like look at all these ranges. They differ. You got days where there's big movement. You got days where there's not much movement at all. What an ATR stop does, it calculates the average trading range over a period. So you decide what the period might be. Say you might say, look, I want the average trading range calculated over the last 2 weeks or the last month or whatever it may be. And then you get that average, and say the average is 10 cents. Say it's got a 10-cent range. And then you put a multiple to that. So I use a multiple of 10. Now you could use a multiple of 2 if you want a close stop, or 5 or 7, whatever it may be. I use 10. It's a round number. It's not a special number, but it's good for me. It provides plenty of room to move, but it's not open-ended. It does have an endpoint. So it'll be, average trading range, say, is 10 cents, times it by 10. So $1 will be the width of the range. Again, it uses a trade's high, and then it will project down $1, and that will be where the trailing stop will be. The calculation can be done, calculation is done every day, but the average width of the range is always going to be changing. That's why I say it's dynamic. So the average, say, 2-week range might be 10 cents today, but then next month maybe there's a period of volatility and the average blows out to 20 cents. So it's going to be a wider stop. Or maybe we go through a period of consolidation where not much is happening and the average is 5 cents. So 5 times 10 is 50 cents. It's going to be a tighter stop. So it's dynamically adjusting. So volatile stocks will be given more room to move. Stocks without much volatility, the stop will come in a lot closer. So it really depends on the situation. That's why I like it. So like if you're trading a property trust, you've probably got a close stop. If you're trading a speculative mining stock, it's going to automatically calculate that wider stop for you. And it looks similar to the percentage base in that you can see that it tracks up beneath the share price, goes through a pause when there's no change in the high, and just keeps ratcheting on up. The disadvantage, I think, for most people is that it's just harder to calculate. You've got to have some software to do the calculations for you, so there's a bit more work to it. And the stops will tend to be wider. So I'll show you. Let's put our 25% trailing stop back on. And you can see in this situation, given the volatility profile of the stock, the trailing stop on the ATR method and the multiple that we're using, the ATR method is giving a wider stop than the 25% stop. And so this is the other thing to bear in mind with the volatility based, is that you're going to have wider stops. Now, I don't see that as a disadvantage. I think it's a strength of the system, or a strength in the calculation, because as prices move around more, you're giving it more breathing space, which I think is important. Some of these more volatile stocks, 25% won't keep you in. I'll find an example in a moment of like how. Let's do it. Find an example now. So say let's jump over to zip code. So this is more volatile. Let's put zip on up here on the screen. Now I'm just going to adjust this. So here's our 25%. You can see our 25% trailing stop. So it's using an exit point. Let's just say, here's our moving averages crossing. Price has gone from below the averages to above. So that creates the buying point. So there's our moving averages cross. Let's say we've got a breakout and we put on a position. We've got one position using a 25% trailing stop, stays 25% below the high, runs for a bit, then gets stopped out. Here's our much wider ATR-based stop. Because it's a volatile stock, it gives it more room to move, and the trade continues. The 25% gets stopped. The ATR stays in and continues to be in this trade, but giving it lots of room to move around. The 25% stop, maybe you re-enter, and people say, oh, look, I'll just get in and out. That's all easy and well and good and to say that, but to actually manage the portfolio, it's more active. You've got to be looking at things more often. You've actually got to get out. You've actually got to get back in. There's more work and it's harder. I prefer to just sit and do nothing and let the thing just work when it's working. So this is a good comparison between the percentage base and the ATR on a volatile stock. What would happen though if we went to a stock without so much volatility? So a stock which has been in an uptrend, a bigger stock, is Goodman Group. So that is, ticker code for Goodman is GMG. Goodman's a top 50 company. So have a look at how two strategies work with Goodman. Where's our moving averages cross? They cross back here. So I'm just going to adjust where the ATR stop starts from. Actually, we can probably start it a little bit further back. So there's some moving. It's gone from below the averages to above. The averages have crossed. So let's say we got that breakout. Notice how the ATR stop is now closer than the 25% trailing stop. So you're actually getting a closer stop with an ATR. And that's because it's a less volatile stock. So this is why what I said earlier, the ATR will dynamically adjust to the stock's situation. So percentage base is good. I think for a lot of people, it's probably the simplest one to use. But the disadvantage is that it's one size fits all. Whereas the ATR, if you're trading Goodman, you got one set of variables. If you're trading Zip, you've got another one. And so I find it's better. That's why I prefer that. But if you can't do the calculations, I think a 25% trailing stop for a medium-term approach is really good because it does give you that endpoint. Because the problem for a lot of people is they end up with something like this. I'll pick on a lithium stock because it really provides the example. So look at. Let's flick all this around. Yeah, and this isn't even. Let's go to this period here. So this is where Chalice was everyone's favourite lithium stock. I'm going to move my trailing stop over here. So yeah, Chalice was the lithium stock of choice. It had gone from under $1 to $10. I'm sure there are people who were holding at $10 who still have it now. But if you had a stop loss strategy, the 25% trailing stop had an endpoint in 21. The wide ATR eventually got out in 22, and then look where the share price has gone. So if you don't have an exit strategy, it can be a disaster. But if you've got your stop strategies in place, you can get yourself out of these stocks, which then just come apart. That's why we use them. It's great if you're in a stock. You want to hold CBA from the float, but most stocks aren't going to be CBA from the float. Most stocks they're going to go up, they're going to go down, they're going to have. Most stocks are probably going to underperform the ASX. So we talk about the whole 2,000 stocks. Most stocks are going to underperform. So you need to be active about getting out of the ones which are underperforming. At least that's what I think, because you don't want to get stuck with several of these in your portfolio, which there's situations you can avoid with a simple strategy like a trailing stop. So that's I think, Rog, strategies people can use to take forward. ATR, percentage, or moving average.
No, I love it, Jace. To be honest, it's it's echoing here myself. I think it's such an important tool for most people to understand and learn. Now, obviously, you don't need to use. No one needs to use them, right? But the amount of horror stories I hear, I just felt like we need to talk about this and have a show around it. And it might look complicated for a lot of people, but I think this is where the discovery work of people being able to see our videos, and especially people, clients or people that may not have been exposed to some of these things in the past, at least start learning a little bit more about it, right? I think, it's you might not be that type of trader, you might not be that type of investor, and just want to put the money in and just forget it, and whatever happens, right? But I know so many people, like you said, Jace, most stocks won't go the way you want them to go, right? So having a bit of a plan, even if you don't call yourself an active trader or whatever, having a bit of a plan when you're reviewing your stocks on a daily basis or on a weekly basis, being able to have a look at the charts and being able to do these simple, easy things to improve your your knowledge and your portfolio over time. It's super important, right? So I don't know. What do you think, Jace? What do you think?
Yeah, it's like, it's not to say somebody can't buy and hold BHP and CBA and everything else, stocks like that. But I think for most people, if they want to buy and hold, I think the best buy and hold is to just hold the ASX 200, because that's going to dynamically adjust itself. If a stock is underperforming the ASX 200, it gets booted out, another stock comes in. So if you want to buy and hold, there's nothing wrong with that. It's a great way for most people to approach the market. I think an ETF is the play. To buy and hold an individual stock, I think it's got problems. So people say, but I've held CBA since the float and I've done really well. And then, well, we can say, well, that's all good. You've done really well, but what if you've held this bad guy since the float? Let's put on a weekly so we can get the float. What if you've held this since the float? Well, it's not so flash, but an exit strategy could have gotten you out long ago. And there have been periods. So there was a period from 2011 to 2015 where Telstra did well. It went from $2.50, say, to over $6. So it more than doubled. But it's been pretty miserable since. But if you had a simple 25% trailing stop, you're out of there in 2016 to go and do other things, and someone else has been sitting there. They've been getting a dividend, but their capital hasn't done too much. You got someone else who had some AMP policies and got some AMP in the float. How are they looking now? So for every CBA someone wants to use as an example, I think we're probably going to find more where you say, look, some sort of process of managing risk and jettisoning stocks that don't perform is probably going to be beneficial. It's buy and hold is a tricky thing. If you're holding the magic stock, that's terrific, but most people don't have. I don't think anyone's got 10 PHPs or CBAs in their portfolio, because there's just not that many stocks which have been amazing over a long period of time. There are some, but we only know in hindsight as well which are the ones we wanted to hold for the last 20 years and which ones we wanted to avoid. So that active strategy of being able to move them on, I think is beneficial. If you want to buy and hold, I'd go the ASX 200 ETF, because that will, stocks like AMP, which underperform, will ultimately leave the ASX 200 ETF in favour of other stocks. That'd be my buy and hold strategy.
Yeah. All right, fantastic, Jace. I think we'll leave it at that for today. Obviously, everything we say or do, if you want to buy and hold and hold through all your losses, or gains. That's totally up to you. Please do that. Obviously, we're not telling you to go out there and start using stop loss strategies on all your stocks now, right? We're giving you options. I'd like to think of it, we're turning people into smarter money managers, right? With some of the things that we talk about, right? With their own money management in the share world and the